All right, let's talk about that one audit topic. You know, the one that students always seem to underestimate. They think, oh, it's just like any other audit. And then, bam, they lose critical marks in their ICAI exams. Well, that topic is special audits. And today, we're going to go deep, I mean really deep, into the biggest one of them all, the CAG. And trust me, this isn't just about scraping through your exam. It's about getting a handle on a massive piece of our country's financial system.
Okay, so let me ask you something. You know how to audit a regular company, right? You've probably even gone through how to audit, say, a hospital or a club. But is that really the same as auditing the entire government of India? Think about it. The scale is just mind-boggling. The rules are a completely different ballgame and the stakes way, way higher.
And right there, that's the trap. It's a huge mistake a lot of students make thinking all audits are basically the same. And I'm telling you, that one assumption is exactly where you lose marks in the exam hall. So, to make sure that does not happen to you, we're going to deconstruct an absolute ICAI favorite, the Comptroller and Auditor General of India. You know him, the CAG.
Let's put this into a real exam-style scenario. Just imagine, you open up the news one morning and a new CAG report has just dropped. Parliament is in complete chaos. The media is going wild, and suddenly, the government's auditor is the most talked about person in the entire country.
Okay, now imagine your exam paper has a case study based on exactly this situation. To even start thinking about an answer, you've got to have the basics down cold. Like, who is the CAG? What makes their job so incredibly powerful? What are their specific duties when it comes to government spending and income? And what about government companies? You know, the PSUs. Do they have any power there? And maybe most importantly, how do we make sure the CAG stays independent? These are the big questions we're going to tackle today.
All right, first up, let's meet India's Supreme Auditor and really understand the constitutional authority behind this role. So CAG stands for the Comptroller and Auditor General of India. But look at that term on the screen, Supreme Audit Institution of India. Now, this is important. That's not just some fancy job title. It's a constitutional designation. What does that mean? It means the CAG's power comes directly from the Constitution itself. This puts the office right at the very top of the food chain when it comes to auditing in India.
Okay, moving on to our second section, let's talk about auditing government spending. This is where we start following the money trail.
So, when the CAG looks at any government spending, it really boils down to two core checks. Super simple, actually. First, did the spending follow the law and all the financial rules? We call that the audit against rules and orders. And second, was the spending actually approved, sanctioned by someone who had the authority to do it? That's the audit of sanctions. Every single rupee the government spends has got to pass both of these tests.
Let's dig a little deeper into that first one, the audit against rules and orders. Now, the textbook calls this a quasi-judicial check. That sounds complicated, but all it really means is that the auditor has to act a bit like a judge. They have to interpret the Constitution, the laws, the financial rules, all of it, to decide if the spending was legit. It's all about making sure every penny spent fits within the legal and financial framework.
So what kind of rules are we talking about here? Well, things like treasury rules, all the procedures for how government employees handle money, and of course all the rules on service conditions. Pay allowances, pensions, the whole shebang. Now listen up, because this is a massive exam tip. This is where ICAI loves to twist the question. The CAG's job is to check the application of these rules. Were they followed? That's it. It is absolutely not the CAG's job to say what the rules should be. Making the rules is the government's job. The audit is all about checking compliance. Think of it like a referee enforcing the rules of the game, not writing the rule book. All right, the second check, the audit of sanctions, is a bit more straightforward. The key word here is authorization. For every single thing the government spends money on, the auditor has to find a sanction, basically an approval from the right person or department. No sanction, then the expenditure is irregular. Simple as that. It's one of the most fundamental checks they do.
Okay, so we've covered how money goes out. Now let's flip the coin and look at how money comes in. Time for Section 3, Auditing Government Income, which is all about verifying the receipts.
When it comes to auditing receipts, the CAG's team has a 5-point checklist. First, they ask, has all the money that was due to the government actually been assessed and collected? Simple enough. Second, are there proper systems in place for doing that assessment and collection? Third, and here's the point ICAI loves to test, it's not enough for the systems to exist on paper. Are they actually being followed? Fourth, are there checks and balances to catch fraud or stop revenue from leaking out? And finally, they look at the whole system to see if they can suggest ways to make it better.
Now, this leads to another classic mistake students make. They get bogged down thinking a receipt audit is about checking every single tax return or every challan. And yeah, that can be a part of it. But the main principle, the big idea, is to audit the general system. The CAG is way more interested in whether the entire system for collecting revenue is working properly, not just picking at a few individual transactions. It's a system-level check. That's a super important concept to remember.
Okay, let's move on to section 4, and this one is really important for your exams. The CAG's power over companies, because their job doesn't stop at government departments, not by a long shot.
So what exactly can the CAG do when it comes to government companies? Well, they've got some serious power. They can decide to conduct a supplementary or test audit, basically an extra layer of checking on top of the normal company audit. They can appoint a CA firm to do this audit for them. They can also demand pretty much any extra information they want, and they can even tell the company exactly how they want that information presented. It gives them a huge amount of oversight.
All right, time for our final section. So far, we've been laser-focused on the CAG, but now let's zoom out a bit and look at the general principles that apply to all special audits. It doesn't matter if it's an NGO, a hospital, or a local club. These are the foundational principles you need to know.
And as you can see here, the key idea is that even though the entities look really different, a hospital, an NGO, you name it, the core principles of how you audit them are actually very consistent. There's a lot of common ground. So let's break down what those fundamental checks are.
So, for any special entity you're auditing, here's your game plan. The very first thing you do is look at its constitution. That could be a trust deed, regulations, whatever it is. You have to know the rules of the game. Next, you check the powers of the management. Did they stay within their limits? Then you dive into the minute books to see what big decisions were made. After that, you've got to evaluate their internal control system to see if it's any good. And then, of course, you do your standard audit stuff. Check their accounting policies and records, look at the income and expenses, and verify all the assets and liabilities. Think of these 7 points as your universal checklist for any special audit.
And look, this quote brings us full circle, right back to that key point we made about the CAG earlier. The job of the audit is to see that rules, regulations, and orders are applied properly, not to decide what those rules should be. The auditor is the referee, not the one writing the rulebook. I'm telling you, getting that distinction clear in your head is absolutely key for a high-scoring answer.
The audit of special entities like local bodies and NGOs. But before we get into the details, let me ask you something. In a normal company audit, you see an expense, you vouch it against an invoice, you check the authorization, and, well, you move on, right? But what if I told you that in some audits, that's barely scratching the surface? That a transaction that looks absolutely perfect on paper could actually be a massive red flag for you as the auditor?
Okay, let's make this real with an exam-style scenario. Picture this. A municipal corporation spends 5 crore rupees to build a shiny new public park. You're the auditor. You've seen the payment details, you've checked the contractor's invoice, and everything seems to be in order. So is your work done for this transaction? The answer is a big, fat no. And today, we're going to find out exactly why.
So why isn't our audit of that 5 crore rupee park finished? Well, the answer lies in the unique world of auditing local government bodies. You see, these aren't your typical profit-making companies, and that fact alone changes the entire ballgame for an auditor. First things first, we've got to know who we're even talking about. And this is a classic knowledge-based question, so pay close attention. In India, there are 5 main types of urban local authorities. You've got your municipal corporations, municipal councils, notified area committees, town area committees, and finally, cantonment committees. You should probably have these 5 names ready to go. So where does their money actually go? I mean, they're not making widgets or selling software. Their spending is all about public services. This breaks down into these broad categories you see here: general admin, public health, so think sanitation, hospitals, public safety, like fire services, education, and of course, public works, which is exactly where that park from our example fits in. And where does the money come from? Well, besides taxes, a huge chunk comes from government grants, and it is absolutely crucial that you know the 3 types. First, you have general purpose grants. These are just to fill an overall budget gap. Second, there are specific purpose grants, which are, you guessed it, tied to a very specific project. And third, you have statutory and compensatory grants, which are given to make up for some kind of lost revenue. ICAI just loves to frame questions around these distinctions.
Okay, so now that we know who these bodies are and kind of how their money flows, let's build on that and look at the audit plan itself. This is where the approach really starts to look different from a standard corporate audit.
Okay, here is a classic ICAI trap. You absolutely need to watch out for this.
In regular accounting, we're obsessed with that clean line between revenue and capital expenditure, right? But in a lot of municipal budgets, there's no such strict separation. They often just use a single head called extraordinary items to cover a bunch of capital transactions. You have to remember this. It's a really fundamental difference.
So as auditors here, what are we even trying to achieve? Well, some of these objectives look familiar. Checking if the financial statements are fair, checking the strength of internal controls, finding errors or fraud. But the two that really stand out, the ones that are different, are adherence to legal requirements and getting value for money. These 2 points are what really define a local body audit.
This brings us to a really powerful tool the auditor has in this area. If an official spends public money on something they had absolutely no legal authority for, an act we call ultravires, the auditor can impose something called a surcharge. This is basically a penalty that makes that official personally on the hook to repay the money. This is where marks are definitely lost. You have to connect the term surcharge with an ultravires act.
Okay, it's time for a critical exam tip. I just mentioned value for money. How does ICAI test this? Trust me, they won't just ask for a definition. They expect you to explain it using what's called the 3 E's. For full marks, you absolutely must write these down: economy, efficiency, and effectiveness. So, did the corporation build the park at a low cost? That's economy. Did they do it without wasting time or materials? That's efficiency. And is the park actually being used by people like it was supposed to be? That's effectiveness. It's also really important to get the difference between internal and external audit straight in your head here. The internal audit, well, that's done by the municipality's own staff. We're focused on the external audit, which is an independent check. Now, the key detail to remember for your exam is who appoints them. The external auditor is usually appointed by the state government, although some really large corporations, like in Delhi and Mumbai, have the power to appoint their own. So how do you put all this into practice? Well, your audit program should pretty much follow this checklist. 1, check that your own appointment is valid. 2, make sure all the spending follows the laws and rules. That's that legal adherence point. 3, verify every single expense was properly sanctioned. 4, confirm the money actually came from a valid provision in the budget. And 5, assess the performance. That's your value for money check right there in action. All right, we've pretty much cracked local bodies. Now, let's totally switch gears and tackle the second special entity for today: non-governmental organizations, or as we all know them, NGOs. See, unlike a regular company that's chasing profits, an NGO is driven by its mission. They exist to achieve some kind of social goal. And this fundamental difference in their very purpose changes everything about how we need to audit them. We're not just auditing for profit, we are auditing for purpose. An NGO can take one of 3 legal forms, and you really need to know the accounting rules for each. It can be a society, a trust, or a Section 8 company. Now, pay super close attention to the basis of accounting. For societies and trusts, the accounts can be kept on either a cash or an accrual basis. But, and this is the key part, for a Section 8 company, accrual basis accounting is mandatory under the Companies Act. That's a very important distinction that's perfect for an exam question. Let's dive into the absolute heart of an NGO audit. And, honestly, where most of the exam questions come from: tracking the funds. Where does the money come from, and how is it used? You will 100% see this term corpus contribution. What is it? It's a donation that's given with a specific instruction from the donor that it must form part of the capital or corpus of the NGO. This means it is not income. It's a capital receipt, and it goes straight to the liability side of the balance sheet. And look, this isn't just some accounting preference. It's backed by the law. Section 11(1)(d) of the Income Tax Act specifically says that corpus contributions are not included when you calculate an NGO's total income. This is why getting the accounting treatment right is so incredibly critical. Another special thing you might come across is a revolving fund. Basically, it's a grant used to give out small, temporary loans. The loans are then recovered, and that money is loaned out again. It revolves. Now, the tricky part is the interest earned on these loans. It can either be added back to the fund itself, making it bigger, or it can be credited to the income and expenditure account. Which one is correct? Well, it depends entirely on the rules laid down by the person who gave the grant. NGOs don't just get cash. A lot of times they get contributions in kind. This could be anything from a building to food packets for distribution or books for a library. As the auditor, you can't just ignore these non-cash items. You have to verify how they were valued, and even more importantly, you have to confirm that they were actually used for the intended charitable purpose. All right, we're on the home stretch.
let's wrap this up with the official rules about the NGO auditor's role and how they get appointed. This stuff is really important for those one-mark questions.
So who appoints the auditor? Well, it goes right back to the legal structure we talked about earlier. For an NGO that's registered as a society or a trust, the management or the trustees appoint the auditor. But if it's a Section 8 company, then just like any other company, it's the members who appoint the auditor. It's a simple difference that makes for a very easy MCQ.
The audit of different types of entities. We're going to break it all down, keep it simple, and make sure you're rock solid on this for exam day. All right, let's jump straight into a classic exam scenario. Picture this. You've just been appointed as the auditor for a brand new partnership client. You walk in on day one. What is the absolute number one, very first document you ask for to kick things off? Take a second and think. I'll give you a hint. It's not the balance sheet. It's not the P&L account. This is a classic ICAI opener. And honestly, if you get this wrong, you've stumbled at the first hurdle. This is literally where marks get lost before the real audit even begins. Okay, section 1. So before we even start looking at ledgers or vouchers, we have to talk about the engagement itself. This is the starting block for any audit of a non-corporate entity, and it really sets the stage for everything that follows. Let's begin with the most straightforward structure, the sole proprietorship. It's pretty simple. The owner calls all the shots. They hire you. And this is a really key point. They can decide the scope of your work. They might say, hey, just audit my revenue, nothing else. Now, because of that flexibility, the engagement letter isn't just a piece of paper, it becomes your shield. This is so important. You have to get your scope defined in writing to avoid any misunderstandings later. And one more thing, if you're taking over from another auditor, you are professionally required to communicate with them. It's not just being polite. You need to find out if there are any professional reasons why you shouldn't take the job. All right, now we're moving into territory that ICAI absolutely loves to test, partnerships. The concepts we cover right here, right now, are the building blocks for so many exam questions. And here it is, the answer to our opening question. The first, the most critical, the non-negotiable document you must examine for a partnership is the partnership deed. Think of this as the rulebook, the constitution of the firm. Everything, and I mean everything, from how profits are shared to what salary a partner can draw, is governed by this single document. So you shouldn't just read the deed. You should treat it as your master audit checklist. Every single clause points to something you need to verify. You check the business name and nature to make sure they're doing what they're supposed to be doing. You trace the capital contributions from each partner to their bank records. And here's a huge one. This is where ICAI loves to twist things, the profit and loss sharing ratio. Your job is to make sure the profit distribution in the accounts follows this ratio to the letter. Any difference, no matter how small, is a misstatement. Let's keep going down our checklist. The deed will tell you the firm's borrowing limit. If they took out a loan bigger than that, you found a major compliance issue. And please pay close attention to this next part, because this is where a lot of marks are lost. Any payment to a partner, whether it's interest on their capital, a salary, or commission, it must be explicitly mentioned and allowed in the deed. If you see a salary paid to a partner and you can't find the clause that allows it in the deed, well, that's an unauthorized payment. It's as black and white as that. Now, besides the deed, there are a few other essential steps. Just like with a proprietorship, get that appointment letter signed to lock in what you are and are not doing. If the firm keeps a minute book, you need to review it for any major decisions on things like loans or big asset purchases. Always double-check that the business activities align with the objects clause in the deed. And then, 2 final critical checks. 1, make sure income tax for the firm is accounted for before the profit is divided. And 2, your final check is that the profit split between partners exactly matches the ratio in the deed. Okay, so now that we've got a handle on partnerships, let's look at its modern cousin, the limited liability partnership, or LLP. The best way to think about an LLP is as a hybrid, part company, part partnership. And that means our audit approach has to be a hybrid too. So what exactly is an LLP? Well, it's governed by the LLP Act of 2008, and it basically gives you the best of both worlds. Partners get the limited liability that you'd see on a company, but they get to operate with the flexibility of a traditional partnership. The main rule you need to remember is that an LLP must have at least 2 designated partners, and each one needs a designated partner identification number, or DPIN. And here's some good news. If you understood the partnership audit, you're already 90% of the way there with an LLP. Just like the partnership deed is the heart of a partnership audit, the LLP agreement is the heart of an LLP audit.
You'll be looking for all the same things: capital contributions, profit-sharing ratios, rules for drawings, partner salaries, borrowing limits, you name it. Your fundamental job is exactly the same. Make sure the LLP's activities are in line with its governing agreement. All right, let's switch gears and look at a special type of audit that requires a very specific focus, especially when it comes to revenue and internal controls. We're talking about auditing a hotel. When you walk into a hotel audit, you have to immediately recognize the risks. You're dealing with a massive number of daily transactions, and a lot of them are cash-based. On top of that, many of the source documents, like kitchen order tickets or guest check-in slips, are pretty flimsy and can get lost easily. Because of this, verifying revenue becomes incredibly challenging, and you end up relying heavily on the strength of the hotel's internal control system. So where do you put your energy? First off, revenue verification is the #1 risk area. A classic audit technique here is to take a sample of restaurant bills and trace them back to the kitchen order tickets, or KOTs, to make sure every order was billed. Second, and this is a really crucial point, you have to lean heavily on analytical procedures, like checking the gross margin. If the internal controls are weak and that margin is all over the place with no good explanation, you might be forced to qualify your audit report. It's a big deal. And of course, you have to make sure all the various taxes they collect from customers are actually being paid over to the government on time.
Now, here's a classic exam trap that often comes up in hotel audits: the difference between revenue and capital expenditure. You've got to be sharp here. Are they just doing minor repairs or redecorating a room? That's a revenue expense. But are they doing a major structural alteration or adding a whole new swimming pool? That's got to be capitalized. Getting this classification right is a huge part of the audit. And here's another little detail to watch out for. Hotels have these things called quasi-fixed assets. Think about the huge stocks of cutlery, glasses, and bed linen. They aren't your typical fixed assets. A lot of hotels treat them more like inventory and value them at the end of the year. The key here is that the hotel needs to have a clear, written policy for how they account for these items, and your job is to check that they're following that policy consistently. Okay, let's zoom out for a minute and talk about some universal truths of auditing. The principles for verifying assets and liabilities we're about to cover are the foundation. They apply everywhere, whether it's a tiny one-person shop or a massive luxury hotel. For every single asset you see on a balance sheet, you have to ask 3 questions. 1, existence, does this thing actually exist? 2, ownership, does the business really own it? And 3, valuation, is it recorded at the right value? The rules are straightforward. Fixed assets are at cost minus depreciation, and remember to capitalize costs like installation. Current assets are at cost or market price, whichever is lower. And for liabilities, the main goal is completeness, making sure everything the company owes is actually on the books. And don't ever forget contingent liabilities. Even if they're not a number on the balance sheet, they absolutely must be disclosed in the notes. All right, we're in the home stretch. Let's wrap up with a quick fire revision round to make sure these key points are locked in your memory. Think of this like a mini mock exam straight from ICII. Okay, you ready? First one, true or false? Small LLPs are mandatorily required to get their accounts audited. What do you think? The answer is false. This is a key difference between companies and LLPs. There are turnover and capital contribution thresholds that provide an audit exemption for smaller LLPs. This is a favorite question for MCQs or the true/false with reasons section, and knowing this detail can save you some easy marks.